Top 7 Psychological Mistakes that Blow Out Trading Accounts and How to Fix Them. He had watched traders rise and fall. Some made fortunes in months, while others wiped out years of savings in a single afternoon. And the strange thing? Their failures rarely came from a lack of strategy. They failed because of what was happening inside their minds. Jesse Livermore once said that the game of speculation is not played against the market, it is played inside a man's own head. And today, millions of traders are silently losing that internal battle. Every blown account, every revenge trade, every premature exit, every oversized position, they all have the same root cause. Not the market, not the broker, not the strategy, but psychology. And the trader who finally understands this truth begins the journey toward mastery. Most traders start with enthusiasm. They watch charts for hours, learn new indicators, take courses, backtest, and chase promising setups. But somewhere along the line, something happens. A moment of confusion, fear, or impatience, and suddenly the plan collapses. A single emotional decision begins a chain reaction. Before they know it, the account spirals. The trader sits in shock, staring at the equity curve, wondering how a few innocent mistakes became a disaster. What they don't realize is that trading has always been a psychological war disguised as a technical game. The very first psychological mistake that wipes out traders is the illusion of certainty. New traders want guarantees. They want perfect entries, indicators that never fail, strategies with 90% win rates. They want the market to behave in a stable, predictable way. But markets are living organisms, wild, unstable, chaotic. When traders expect certainty in a world built on probability, they panic the moment reality strikes. They hesitate when they should execute, and they execute impulsively when they should wait. The fix lies in adopting a probabilistic mindset. The best traders understand that every trade is just a probability, never a guarantee. They risk small, stay detached, and evaluate trades in batches rather than individually. One trade means nothing. One loss means nothing. The game is measured over hundreds of outcomes, not one. The trader who finally internalizes this truth stops treating losses as personal failures. He treats them as the price of doing business. The second psychological mistake that blows accounts is emotional attachment to outcomes. Traders fall in love with trades. They want a trade to work. They want to be right. They want to prove to themselves that all their analysis was correct. So when price moves against them, they hold on. They pray. They adjust stops, they widen targets, they convince themselves the market will reverse. And when hope fails, the account pays the price. Fixing this requires one shift: detachment. A trader must never marry a trade. If the setup proves invalid, he exits immediately without negotiation. In the mind of a disciplined trader, being wrong is normal. Being stubborn is fatal. Jesse Livermore warned that hope and fear are traders' greatest enemies. Hope keeps losing trades alive. Fear destroys winning ones. When a trader releases emotional attachment, he trades with clarity. The third psychological mistake that destroys accounts is FOMO, the fear of missing out. A candle surges upward, and suddenly the trader's heart rate spikes. He feels the need to jump in, even when the setup is gone. He enters late, chases price, and ends up buying at the high or selling at the low. FOMO is the silent killer that wipes out accounts slowly and painfully. The solution is simple, but difficult. The trader must only take trades that match his rules. Anything else is poison. A real trader understands that missing a trade is not the same as losing money. There will always be another opportunity, always. The market never stops printing setups. The trader who learns to let the market go without him becomes more patient, more confident, and far more profitable. The fourth psychological mistake is revenge trading. It happens after a painful loss. The trader becomes emotional, angry, frustrated, embarrassed, and tries to earn it back immediately. He increases position size. He abandons analysis. He trades from adrenaline instead of logic. Revenge trading is the fastest, most aggressive way to blow an account. It destroys balance, wipes risk management off the table, and transforms a rational trader into a gambler. To fix it, traders must build a simple rule. After any emotional loss, stop trading immediately. Step away, reset, breathe. No trader can think clearly with a wounded ego. The mind needs space to recover. A trader who continues after an emotional loss is no longer trading the market. He is trading his pain. At this point in the video, if you're getting value from this insight into trading psychology, make sure to subscribe, like the video, and drop a comment below. More traders need this knowledge, and your engagement helps this message reach them. Now, the fifth psychological mistake that leads to disaster is overconfidence after a winning streak. Wins feel good, dangerously good. After 3 or 4 consecutive winning trades, the brain releases dopamine. The trader begins to feel untouchable. He begins to think his analysis is superior. He increases position sizes. He takes trades that don't fit the plan. He starts behaving like a genius. And then the market humbles him violently. The solution is humility. After a winning streak, the trader must become even more disciplined. He must reduce his size, not increase it. He must follow rules, not loosen them. Success creates illusions, and illusions create losses. A real trader knows that winning streaks are often the beginning of losing streaks if psychology is not controlled. The sixth psychological mistake is fear-based exit. Traders enter a valid trade, watch it move in their favor, and then panic at the first small pullback. They exit early, destroying their risk-to-reward ratio. They take profits too fast and let losses run too long, the exact opposite of professional behavior. Fear of giving back profits leads the trader to sabotage his own edge. Fixing this requires trust. Trust in the setup, trust in risk management, trust in the plan. A trader must define his exit rules before entering the trade, and once the trade is live, he must follow those rules without letting fear interfere. The market breathes. Pullbacks are normal. The trader who learns to stay calm during them becomes powerful. The seventh psychological mistake is the most devastating of all. Lack of self-awareness. A trader cannot fix what he cannot see. If he does not study his past trades, track his weaknesses, identify his emotional triggers, and understand his personal behavioral patterns, he repeats the same mistakes forever. Most traders are blind to themselves. They blame the strategy, the broker, the spread, the news, everyone except the person holding the mouse. The solution is journaling. Not just numbers and screenshots, emotional journaling. Documenting the state of mind before, during, and after a trade. Tracking triggers, tracking impulses, tracking patterns. Because psychology cannot improve without awareness. A trader who becomes aware of his tendencies begins to see the truth. The market is not the enemy. The market is neutral. It is simply a mirror reflecting back every strength, every weakness, and every hidden flaw the trader carries within himself. When a trader sits in front of the chart, he is not fighting liquidity, or institutions, or the algorithm. He is fighting his own fear, his own greed, his own impatience, and his own ego. And the moment he realizes this, trading transforms from a frustrating struggle into a journey of personal mastery. Most traders underestimate how deeply human psychology affects market behavior. They assume that success comes from learning a strategy or copying signals. But strategies are everywhere. Psychological discipline is rare. A trader with a weak mind will sabotage even the best strategy. A trader with a strong mind can turn almost any decent strategy into a weapon. The difference is not the chart. It's the character behind the chart. One of the most damaging psychological traps traders fall into is the illusion of quick success. Social media, flashy profits, and exaggerated stories create a false expectation. New traders expect to be profitable within months. They believe consistency is something they stumble into rather than something they grow into. They watch others post insane returns and assume they are falling behind. This creates pressure to trade more, risk more, and prove something. And pressure is the oxygen of emotional mistakes. The solution is patience, real patience, the kind of patience that accepts the idea that becoming a profitable trader can take years of refining habits, not weeks of chasing setups. A trader must understand the process. The market rewards consistency, not speed.
Just as a farmer cannot rush the rain or the harvest, a trader cannot rush profitability. Those who try always lose more than they gain. A trader who accepts the long journey becomes calmer, more disciplined, and more aware. Another psychological issue is identity-based trading. Many traders attach their self-worth to their results. When they win, they feel intelligent, strong, capable. When they lose, they feel stupid, weak, or incompetent. This emotional volatility leads to impulsive behavior. Traders stop being objective analysts and start being emotionally reactive gamblers. And traders who take losses personally will always spiral. To fix this, a trader must separate identity from outcome. A winning trade does not make him a genius. A losing trade does not make him foolish. Profitable traders treat trading like a business. They analyze, execute, and review without attaching ego to results. They understand that trading is a skill, not a reflection of their character. Separating identity from outcome is one of the most powerful psychological upgrades a trader can make. There is also the problem of inconsistency. A trader may have a fantastic strategy, but if he cannot follow it consistently, it becomes useless. One day he waits for confirmation. The next day he jumps in early. One day he respects his stop loss. The next day he moves it. One day he risks 1%. The next day he risks 10%.
Just as a farmer cannot rush the rain or the harvest, a trader cannot rush profitability. Those who try always lose more than they gain. A trader who accepts the long journey becomes calmer, more disciplined, and more aware. Another psychological issue is identity-based trading. Many traders attach their self-worth to their results. When they win, they feel intelligent, strong, capable. When they lose, they feel stupid, weak, or incompetent. This emotional volatility leads to impulsive behavior. Traders stop being objective analysts and start being emotionally reactive gamblers. And traders who take losses personally will always spiral. To fix this, a trader must separate identity from outcome. A winning trade does not make him a genius. A losing trade does not make him foolish. Profitable traders treat trading like a business. They analyze, execute, and review, without attaching ego to results. They understand that trading is a skill, not a reflection of their character. Separating identity from outcome is one of the most powerful psychological upgrades a trader can make. There is also the problem of inconsistency. A trader may have a fantastic strategy, but if he cannot follow it consistently, it becomes useless. One day he waits for confirmation. The next day he jumps in early. One day he respects his stop loss. The next day he moves it. One day he risks 1%. The next day he risks 10%. Trading becomes random, emotional, and chaotic. And chaos will always destroy accounts. The solution is automation. Not literal bots, but personal discipline that functions like automation. The trader must build rules so clear that following them becomes non-negotiable. No negotiation, no compromise, no improvisation. The best traders do not make decisions in the moment. They make decisions before the moment and execute without emotional interference. Consistency is not built in the chart. It is built in the mind. At this point, if you're finding this breakdown powerful, remember to like the video, subscribe, and leave a comment below. It helps the channel reach more traders who desperately need psychological mastery. Now, another hidden psychological issue that destroys traders is avoidance. Many traders avoid looking at their losing trades. They avoid journaling. They avoid reviewing mistakes. They avoid facing the truth about their psychology. They avoid doing the hard internal work. Instead, they distract themselves with more indicators, new strategies, new time frames, and new mentors. They keep searching for external solutions because they are afraid of confronting internal weaknesses. To fix this, the trader must do one thing: lean into discomfort. Every losing trade contains a lesson. Every emotional mistake contains a clue. Every blown account contains a warning. Traders become powerful when they stop running from their flaws and begin studying them. The truth is simple. Anyone can copy a strategy, but only disciplined traders can fix themselves. The moment a trader becomes brutally honest with himself, everything begins to change. Another psychological challenge that breaks traders is the inability to accept uncertainty. Traders crave control. They want to control outcomes, control direction, control timing, control the chart. But the market does not bend for anyone. This lack of acceptance creates emotional chaos. When the market behaves unexpectedly, traders panic. They hesitate. They close winning trades too early. They hold losing trades too long. They try to force the market to behave according to their expectations. But mastery is not control. Mastery is acceptance. The trader who embraces uncertainty stops demanding that the market move in his favor. He focuses only on what he can control: risk, entry, exit, behavior. Everything else is noise. The more a trader tries to control the market, the more the market controls him. The moment he stops forcing outcomes, he becomes free. Another deeply rooted mistake is trading from a place of scarcity. Traders fear losing money because they are trading with money they cannot afford to lose, or money that carries emotional weight. Rent money, borrowed money, last savings, family pressure, or unrealistic goals. All of these create emotional desperation, and desperate traders act irrationally. They force trades. They avoid stop losses. They double down. They behave like gamblers. The fix is simple, but uncomfortable. Trade only with money you can emotionally afford to lose, not financially, emotionally. Money you are willing to risk without panic. Money that will not affect your mood, relationships, or daily life. This single shift can improve emotional stability more than any strategy ever will. Then there is the issue of perfectionism. Many traders want the perfect setup, the perfect confirmation, the perfect candle pattern, or the perfect market condition. But perfectionism is a psychological trap. It causes hesitation, lost opportunities, and frustration. The trader becomes overly analytical. He freezes. He stops executing. He becomes a chart philosopher instead of a trader. The solution is embracing imperfection. A trader must understand that no setup is perfect. There will always be uncertainty. There will always be risk. Waiting for perfection is just another form of fear disguised as logic. The confident trader executes based on probability, not perfection. A major psychological mistake traders make is believing they can avoid losses entirely. This single belief is responsible for more blown accounts than any strategy failure. Traders try to outsmart the market, avoid stop losses, pray through a drawdown, or hold a losing trade because they refuse to accept the possibility of being wrong. But no matter how skilled a trader becomes, losses are part of the game. Even the greatest traders, Jesse Livermore, Paul Tudor Jones, Ed Seykota, Mark Minervini, took losses regularly. Not because they were weak, but because losses are part of the mathematics of trading. The solution is acceptance. Losses are not an attack, they are business expenses. A trader who cannot accept losses will never become consistent. The goal is not to avoid losing, the goal is to avoid losing big. Accepting this transforms a trader's confidence, emotions, and execution. Suddenly, every trade becomes just another probability, not a threat to self-worth or financial survival. When losses stop hurting emotionally, the trader is finally ready to grow. The next psychological trap is impulsiveness. Many traders enter trades not because they saw a valid setup, but because they felt like entering. They saw a candle spike. They saw momentum. They saw price moving quickly and couldn't resist. Emotional impulses override logic. This is where traders jump in too early, exit too early, and take setups they were never supposed to touch. Impulsive trading is always a reflection of internal turbulence, not strategy error. The fix is structure. A trader must create a checklist, simple, clear, non-negotiable. If even one item on the checklist fails, the trade is invalid. No guessing, no improvisation, no quick decisions. The checklist becomes the guardian between the trader and his impulses. And over time, the mind begins to absorb the discipline. The trader becomes calmer, slower, more deliberate. His execution sharpens, and the emotional chaos fades. Another deeply rooted psychological mistake is chasing losses. When traders take a losing trade, they feel a sudden emotional urge to fix it.
They want the pain to go away. They want to restore balance. They want revenge. This is revenge trading, the silent account killer. A trader who tries to win back losses immediately is no longer trading the chart. He is trading his emotions, and emotional trading is always destructive. The solution is forced interruption. After a loss, the trader must step away, physically and mentally. Take a break, drink water, walk around, reset. No trader is mentally stable enough to take a logical, objective trade immediately after losing money. The brain is wired for emotional self-defense, not precision. The trader should return only when the mind is calm and objective. This single habit can save thousands of dollars. Another psychological mistake that destroys accounts is the desire to be right. Being right feels good. Being wrong feels painful. So traders try to protect their ego instead of protecting their capital. They hold losing trades because they don't want to admit they were wrong. They avoid stop losses because it feels like surrender. They overanalyze because they want certainty. They argue with the market. They try to force their analysis to match their bias. But the market doesn't reward ego. The market rewards probability, discipline, and emotional neutrality. The fix is humility. A trader must respect the market like a force of nature. Waves don't apologize. Winds don't adjust. The market doesn't move because the trader wants it to. Accepting this removes friction. The trader's goal is not to be right, it's to make money. And often the most profitable traders are those who admit they were wrong the fastest. Another subtle psychological mistake is inconsistency in risk management. Traders often risk 1% on some trades and 5% on others. When they feel confident, they increase risk. When they feel scared, they reduce it. This emotional manipulation of risk creates chaotic equity curves. No consistency equals no predictability, and no predictability equals no long-term success. The solution is fixed risk protocol. The trader must choose a risk percentage, 0.5%, 1%, or 2%, and stick to it with absolute discipline. No adjusting, no experimenting, no emotional deviations. When risk becomes mechanical, the trader finally becomes stable. Many traders also underestimate the psychological power of environment. Trading in a noisy, stressful, or emotionally heavy space increases mistakes. Trading around people who constantly complain, argue, or distract creates instability. The environment influences the mind, and the mind influences trading decisions. The fix is isolation and intentional environment design. The trader must create a space where focus is effortless, quiet, clean, organized, and free of distractions. A powerful trading routine begins with the right environment. Another psychological mistake is ignoring physical health. Fatigue creates bad decisions. Dehydration reduces mental clarity. Lack of exercise increases stress. Poor sleep destroys judgment. Many blown accounts are not caused by bad strategy. They're caused by a tired, unfocused mind. The solution is holistic discipline. Proper sleep, hydration, and minimal stress increase clarity and emotional control. A trader must treat their body like part of the trading system. Finally, one of the deadliest psychological mistakes is inconsistency in journaling. Traders who do not review their trades repeat the same mistakes every week. They do not grow. They do not evolve. They keep losing to the same patterns. Journaling is where growth happens. It is the mirror that shows the truth. To fix this, journaling must become a non-negotiable habit. After every trade, what worked, what didn't, how it felt, and what rule was followed or broken. This is how real improvement happens. By now, the trader watching understands something important. Trading mastery is not about prediction. It is about internal control. Every blown account can be traced back to the same psychological patterns: fear, greed, impulsiveness, ego, inconsistency, and lack of self-awareness. The trader who conquers these becomes powerful, disciplined, and consistent, not because the market became easier, but because his mind became stronger. This is where real transformation begins. The trader must decide: continue trading emotionally or rise above and evolve. Every consistently profitable trader eventually realizes that success in the market is success over oneself. The charts are simply the battlefield. The real war is internal. Before the video ends, viewers are encouraged to subscribe, like, and comment, not just for algorithms, but because the mission of this channel is to help traders develop the strongest edge a person can ever have: the power of a disciplined mind. If this video has opened your eyes, share it with another trader who may need this level of truth. Consistency is possible. Discipline is possible. Psychological mastery is possible. But it begins with awareness, and it grows through deliberate practice. A trader becomes unstoppable when emotions stop leading decisions, when fear loses power, when ego becomes quiet, and when discipline becomes automatic. That is the point where trading becomes simple, calm, profitable, and deeply rewarding. Welcome to Lord C Forex Mastery, where the strongest traders are built from the inside out.